Now let's look at adjustable and floating rate mortgage loans. This topic deals with a variety of mortgage loans with interest rates that are tied to a market rate or index and may change with market conditions. When used to finance single-family residences, these loans are called adjustable mortgage loans. When used to finance commercial properties, these loans are called floating rate mortgage loans. Let's look at price level adjusted mortgages, also commonly referred to as PLAM. So for the price level adjusted mortgage rate, so for the mortgage rate is calculated by adding the real interest rate plus a risk premium and unexpected inflation. After estimating the initial values for the real interest rate and the risk premium, the price level adjusted mortgage loan balance could be adjusted up or down by a price index. Payments will then be based on the new loan balance adjusted for inflation. This will shift the inflation risk to borrowers. The lender is, however, still exposed to the real interest rate and the risk premium. So let's have a look at a practical example of the price level adjusted mortgage. Consider a loan of 60,000 Kenya shillings with a 30-year term. The interest is 4%, and this is the interest inclusive of the risk premium, payable monthly. The loan balance is adjusted for inflation at the beginning of every year based on the consumer price index, or rather CPI. The CPI increase at the end of year 1 is 6%. Compute the loan balance at the end of year 1. So let's do this practically in Excel. So first, let us note the loan amount. So in this case, our loan amount was 60,000. Then the interest rate or interest rate in this case is 4%. And another thing to note is this interest rate is annual. So we have our annual interest of 0.04. However, it's being compounded monthly. So the monthly rate will simply divide this by 12. Now let's look at more information. So this loan is a 30-year loan compounded monthly. So here's 30. Therefore, the months, simply take the 30 times 12. So these are the number of compounding periods. Now for the first year, let's calculate the repayment. first month repayment. So to get this, we'll use the PMT formula. Is equals to PMT, take the monthly rate, total number of periods, and the present value. So this will be the monthly payment. So for the purpose of this example, let's just leave it as a number, and you can also add a negative sign in front, remove the negative. So that's the first month payment. Okay, to have a clear understanding of how this works, let's get an amortization table. So we have our months there, 0, 1, 2. Okay, so in normal cases, we will have dragged this up to 360, but for the purpose of this example, let's just hold it at that first. So here we have our monthly repayment. And then you also need to note the interest amount, the principal, and the loan balance. So for this case, at the beginning of the period, our loan amount is 60,000. So at the end of the first month, we will pay 186.45. So this will be the amount paid for the first month. The interest payment for the first month will be equal to the monthly rate multiplied by the loan balance at the beginning of that period. So in our case, it's the 60,000. For the principal, here we'll simply subtract the interest from the monthly repayment. That's the principal amount paid out during that period. Okay, now here, to get our loan balance, we'll simply take this balance less the principal. However, there's something important to note. There's an increase at the end of the year of 6%. This is the CPI increase. So here you can create another column, CPI increase. Let's call this balance before CPI increase. So the CPI increase for this particular month is 6%, which is 0.06. So for us to get the balance, well, let's just get the actual amount is equals to 0.06 multiplied by the loan balance. Then we get the balance after CPI increase. So we'll simply take this plus this increase. Or alternatively, we could simply multiply this by 1.06. So this is the balance at the end of the first month. We've actually made a mistake in this context, since we assumed that the CPI increase was after the first month. So this CPI increase in this case happens at the end of the first year. So we need to remove this and proceed all the way to the 12th month. So our monthly repayment here will still be constant. So this repayment will be constant for the first 12 months. The interest formula will still hold. The principal will also be okay. So let's drag this down up to 12. There seems to be a mistake here. So another thing to note is we should always be careful when dragging these formulas. The mistake here is I didn't lock in this interest. Okay, so the loan balance at the end of the first year will be 58,943.38. But then there's a CPI increase at the end of the year of 6%. So for this case, we'll have this multiplied by 0.06. Then the effective loan balance after increasing, or rather after adding the inflation, will therefore be this loan balance plus the CPI increase. So the actual loan balance at the end of the first year will be 62,479.98. The price level adjusted mortgages usually have the following problems. So first, the loan balance may exceed the property values. This may increase default risk. The rate of inflation may not match the borrower's income, hence an increment in the risk of default. The price level chosen for indexation is measured on historic or ex post facto. Now let's look at adjustable rate mortgages and floating rate loans. The interest rates for these loans are indexed on other market interest rates and not the price index. For example, consider an adjustable rate mortgage loan of 60,000 Kenya shillings at 10% interest, 30 years term, payable monthly, and interest rates are adjusted at the end of every year. If the interest rate is 12% at the end of year one, compute the monthly repayment for the second year. With this, let us go into Excel and do it practically. In this example, we are considering the loan amount of 60,000 and the interest the first year of 10%, which is 0.1. So the loan term is 30 years. So the total loan term should be in months, since it's compounded on a monthly basis. So that's 30 times 12. Now, based on this information, we need to calculate the monthly repayments. Repayments for year 1. The first year. In this case, is equals to PMT. Take the rate. There's also a mistake there. First, we also need to note the monthly rate, since this is what we'll be using. So to get the monthly rate, we divide our rate by 12. Now let's proceed and calculate the monthly repayments. Is equals to PMT. Take the rate, total number of periods, and the loan amount. So in this case, you note that the monthly repayments for the first year will be 526.54. So let's create our amortization period, our amortization table. So here we have months, we have the monthly repayment, then have the interest, the principal amount, and the loan balance. We can simply highlight this and drag it down up to 12. So here, let's note we had 60,000. The monthly repayments will be equal this amount, which is 526, which you can simply lock that in so that you drag it down the end of the period. Now for the interest, you take the monthly rate multiplied by the loan balance. So for this monthly rate, you need to lock it in so that you can easily drag our formula and save a lot of time. Now the principal, we simply take the monthly rate less the interest payment. And for the balance, we take the earlier balance less the principal payment for that period. Now with that, you can simply drag this down. So now here, we know that at the end of the first year, our loan balance is this amount, 59,666.47. However, the interest rate changes to 12% at the end of this year. So meaning our monthly repayments for the second year will have changed. So for us to get the monthly payments for the second year, so we get the opening loan balance. For the second year, which in this case is this amount, 59,666.47. But the interest rate now has changed, and it has changed to, this is the annual interest for year 2 has changed to 12%, which is 0.12, which means the monthly rate is now 12 divided by 12, which is 1%. The loan period, you need to know that we've already taken 12 months from the earlier loan balance, or rather the loan period, which was 360. So the remaining loan period now is 360 less 12 months. So here we're able now to calculate the second year monthly repayments. So to do this, still use the formula is equals now to PMT. Take the monthly rate, check total number of periods and the opening loan amount. So now your monthly repayments will be 615.97. That's the amount. We can now make the following observations related to adjustable rate mortgages and floating rate loans. The ARMs, or adjustable rate mortgages, do not completely eliminate the lender's interest rate risks. Interests are adjusted at year end, while the rates may increase on any day of the loan. Also, the longer the payment adjustment interval, the greater the interest rate risk to the lender. As the lender assumes less interest rate risk, the borrower incurs more interest rate risks. So other adjustable rate mortgage characteristics are as follows. The index is the interest rate series, such as the LIBOR, agreed upon by both the lender and borrower, and over which the lender has no control. There is a margin. This is a premium in addition to the index chosen for an adjustable rate mortgage, and this margin is also referred to as a spread. There's a composite rate. This is the sum of interest rate based on the index and the margin. There is a reset date. This is the point in time when the mortgage payments will be adjusted. There's negative amortization. This arises when accrued interest in a given period exceeds the period payment. They are caps. These are maximum increases allowed in payments, interest rates, maturity extensions, and negative amortizations on reset dates. There are floors. Floors are maximum reductions allowed in payments or interest rates on reset dates. The ability of the borrower to allow a subsequent purchaser of a property to assume a loan under the existing terms is referred to as assumability. This is also a feature of the ARMs. There are also discount points. As with floating rate mortgages, these points or fees are also used with adjustable rate mortgages to increase the lender's yield. There is prepayment privilege. Most residential borrowers usually have the option to prepay, or rather to pay without penalty. Lockouts. Many commercial mortgage loans prohibit prepayment for a specified number of years. Conversion option. This is the right of an adjustable rate mortgage borrower to convert to a floating rate mortgage. We also have variations to the adjusted rate mortgage and floating rate loans. So for example, we have the 3-1, 5-1, and 7-1 hybrid loans. This category combines elements of the fixed rate mortgages for the period of 3, 5, or 7 years, after which interest rates are preset and the loan becomes an adjustable rate mortgage. A 3-1 hybrid will mean a 3-year fixed rate mortgage, after which the interest will become adjustable, tied to an index, and will be reset each year thereafter. We also have interest-only adjustable rate mortgage and floating rate loans. This requires that the borrower pay interest monthly. Interest payments vary in accordance with the underlying index. Risk premiums, interest rate risk, and default risk. The greater the interest rate risk assumed by the lender, the higher the risk premium charged. The greater the interest rate risk assumed by the lender, the lower the default risk. The expected yield relationship and the interest rate risk. At the time of origination, the expected yield on an adjustable rate mortgage should be less than that of a fixed rate mortgage. The adjustable rate mortgage tied to short-term indexes are generally riskier to borrowers than adjustable rate mortgages tied to long-term indexes because the former are generally more variable. Adjustable rate mortgages with shorter time intervals between adjustments in payments are generally riskier to borrowers than those with longer time periods. To the extent adjustable rate mortgages contain maximum caps on the interest rate adjustments, the interest rate risk incurred by borrowers will be lower. Hence, expected yield will vary. The presence of floors increases the risk to borrowers. If an adjusted rate mortgage has negative amortization due to a payment cap, then the effect of changes in interest rates will not materially reduce interest rate risk to borrowers or the expected yield to lenders, because any interest forgone because of limitations or caps will be deferred and become a part of the loan balance and will eventually be paid by borrowers. So let's have a practical example of adjustable rate mortgage payment mechanisms. Consider a loan of $60,000 with a term of 30 years. We assume that the adjustable rate mortgage interest rate will be adjusted annually. Hence, the first adjustment will occur at the beginning of the second year. At the time, the composite rate will be determined by the index of the 1-year US Treasury security plus 2% margin. If you assume at 1 that the index of 1-year US Treasury securities takes on a pattern of 10, 13, 15, and 10% for the next 4 years based on the forward rates in existence at the time each adjustable rate mortgage is originated. And 2, that the monthly payment interest rate adjustments are made annually. What will payment adjustments, loan balances, and expected yields be for an adjustable rate mortgage with these assumed characteristics? So with this, let's dive into Excel and do this practically. So now, based on this example, we have to consider a loan of 60,000 US dollars with a term of 30 years. So first, let's start capturing this information. So the loan is 60,000. The loan term is 30 years. The months are 30 multiplied by 12, which is 360 months. Now the interest rate in this case will keep on changing. So what we need to first note is that the index of 1-year US Treasury bills on a pattern of 10, 13, 15, and 10. So let us draw this up. So let's create a table indicating this particular information for us to avoid making any mistakes. So this extends to a period of 5 years. And then we also have the index rate, the margin, the charged interest rate, and from this we can be able now to calculate the relevant payments once they're due. So first, for the first year, we don't have any information related to the index rate, but we're assuming the initial rate is 8%. So we'll have a 0.08 there. Then for the second year all the way to the fourth year, the index rates are as follows: 10%, 13, 15, and 10. The margin is 2%. So for this, you need to remember that they're in decimal format. So 0.1, 0.13, 0.15, and 0.1. And then the margin is 2%, which is 0.02. and the margin holds throughout this particular period. So the total interest rate is the index rate plus the margin. Once you drag that down, we have the interest rate, the different periods. So for the first year, the monthly rate will be 0.08 divided by 12. So with this, we can be able to calculate the monthly repayments. For the first year. So to do that, we use the formula is equals to PMT, to brackets, take the rate, the number of periods for the whole loan term, and the loan amount, and close the brackets. So that's our monthly repayment. Let's just add a negative before the formula to get it as a positive number and leave it as a number. Now with this information, you can create the amortization table. So here first we have month, we have the payment, we have the interest, principal, and the balance. Then we have from month 0 up to 12. So our monthly payments will be this amount. Let's simply drag it down. Our interest now for the first period when taking the loan, we need to start with the loan amount up here. So there's no payment for month 0. So the interest you get by multiplying the monthly rate by the balance. And then the principal, we subtract the interest from the monthly payments. And the balance, we simply subtract the principal from the balance. With that, once we drag it down, for the first year, at the end of 12 months, the closing balance will be this amount, 54,498.78. However, for the second year, our monthly rate will have changed to 0.12 divided by 12. And now in this case, our monthly repayments will also change, since the amount now will be is equals to PMT, take the rate, number for the number of periods, we've already taken 12 years out of the total 368. There's actually 348. When to make it more clear, let's just so the loan period. So here in this case is equals to the first total, which was 360 months, less 12, which we've already covered. So it's 348. So with that, we can do is equals to PMT at the rate, comma, total number of periods, and our opening balance, which in this case is from the 12th month, this amount. That's the opening balance on the 13th month. So we find our monthly repayments will have now increased to 614.24. With that, we create another amortization table. Which goes all the way up to the 24th month, since we need to have a total of 12 months. So opening balance here will be equal to this. Our repayments will be equal to this amount. The interest will be that multiplied by balance. So let's lock that cell so that we can easily drag down the interest amount. So for the principal payment, we get that by subtracting the interest from the payment. Simply drag it down to the 24th month and you have your closing balance, the end of the second year. So we can then proceed to the third year. So in the third year, our monthly rate is equals to 15% divided by 12. The loan period is now equals to the previous loan period less 12. So the loan period now, the balance is 336 months. Now with that information, we can then calculate the monthly repayments. So in this case, is equals to PMT. We put in the rate, number of periods, and our present value, which is the balance at the end of the 24th month. Close the brackets, then enter. Now with this information, we can also proceed and create the amortization table again. Now we're moving from the 24th to 36th month. Since we need to cover another full year. Now opening balance is this amount. Our payments in this case are this amount. Now we still continue with the same process and jump to the 4th year. So here, a monthly rate, the 4th year is equals 17% divide by 12. Then we have the loan period, which is remaining. So in this case, it's 336 less 12, which is 324 more months remaining. Now with that information, you can calculate the monthly repayments. For the 4th year, our monthly repayments will be 846 and 20 cents. Then proceed and create your amortization table. Now this will move from 36 all the way to 48. So you'll notice that once you get the monthly repayments, the other steps are similar to the steps which we did earlier, as long as we now take the new amounts. The advantage with Excel, so once you already have the formula captured, you can easily drag and get the other answers. For the principal again, subtract the interest from the payment. Now, since we're done with the 4th year, we can finally move on to the 5th year. So we need to get the monthly rate, which in this case is 12% divided by 12. The loan period take the 324 less 12. Now we can calculate the monthly repayments. Is equals to PMT. Check the rate, number of periods, and the opening balance. Then proceed and create your amortization table. I move it from 48 at 12 months to 60. Capture your opening balance. Then for your payments, always make sure to add the dollar signs so that you lock in any cell before you drag particular formula. So for the interest, take the interest. Multiply this by the loan balance. Principal, take the payment less the interest. And the loan balance, take the earlier balance less the principal paid during that period. That, simply drag it down to the end. So with this information, we now know the loan balance at the end of each period and the different monthly repayments. So this is what usually happens once your rate is adjustable. So each year or each change in the interest rate affects a change in your monthly repayments and subsequently a change in your loan balance over the loan period. Some adjustable rate mortgages include payment caps, which limit your monthly payment increase at the time of each adjustment. Usually, this cap limits at a certain percentage, which is usually based on the previous payment. For example, using our earlier problem, if you assume that for the first Here the interest rate is 9%. And there's a cap of 7.5%. So this means that in the event that the monthly payment increases by more than 75%, we ignore the additional payment and only pay the additional 7.5% over and above the previous payment. So for example, here in the second year, the monthly payment which is supposed to be made is 615.18. However, this amount is greater than 7.5% increase from the previous payment. Since the previous payment, which is 482.77, once we multiply it by 1.075, you realize that the increment should be limited to 518.977. So in such a scenario, this amount will be the one which will be paid here during the monthly payments. So for this example, during the second year, we'll pick the capped payment. Now you can drag that down throughout the 12 months. However, note that the interest payment is still calculated as a percentage of the actual monthly rate which we had used to calculate the uncapped payment. So in this case, let's say this is the uncapped, while this other one, the capped payment. Now, also another important thing to note is that in a case where we cap the payment, the principal payment becomes a negative. This leads to a scenario such that at the end of that period, the loan balance will be higher than the initial loan balance when starting that particular period. So you can move on to the third year. So for the third year, the rate still remains as was in our early example, and the loan period also remains. But for the monthly payment, again, we need to look at the capped payment. So earlier, our monthly payment was 518.98. So the maximum increase which you can get is 7.5%. So let's multiply it by 0.75, 1.075. So again, you realize that this capped amount is lower than the monthly repayments which you get based on our formula here. So again, we'll use the capped payment. Now, you'll also realize again, since we've used the capped payment, the loan balance has increased from the previous loan balance. And then again, the next year, the fourth year, the capped interest, or that the capped increase will be our previous monthly repayments multiplied by 1.075. So now this is the capped monthly repayment. So again, we'll proceed with that and ignore the actual monthly repayment which we should be paying. So with that being done, we can easily now identify the end balances at the end of each year. So you realize that the actual loan balances have continued increasing due to the cap. So in some instances, the banks also have another cap on this negative amortization. So once it reaches a point, let's say the loan balance becomes 125%, or rather increases by 25% of the amount which you are loaned out, they'll affect the actual payment which will be in force for you to be able to start clearing the principal payment. So then again, let's proceed finally to the 5th year. With that being done, at the end of the 5th year, the loan balance will be 67,264. And note, this amount is higher than the loan at the beginning, which was $60,000. We previously looked at a case where the payment is capped. However, in some cases, the interest rate increase can also be capped. So this means that in the event that the calculated interest rate exceeds a certain amount, the affected interest rate will be lower than that amount. So for example, in our earlier problem, let's assume that there's a capped rate of 2%. So this means that the interest rate cannot increase by more than 2%. And then let's also assume our starting interest rate is 11%. So for the second year, since the interest rate is 12% based on the increment from the margin, we still maintain it as 12%. However, from this second year to the third year, we realize that there's an increment of 3%. So we ignore that, and here we'll have 0.14. And then from 0.14, we can only increase by a maximum of 2%. So here we can't exceed 16%. So here you realize it's 17%. So here we go to 16%. And then in the event that it reduces, Unlike where we have a cap on increment, there's no cap on reduction. So we effect the 12%. So in such an example, we'll now calculate the monthly repayments, not based on the actual interest rate, but on the capped interest rate. So here, we need to change our rate. To the actual capped rate. And we do that for all the other months. And then now we need to correct this. What we need here is the monthly rate change. So we take that for consistency here. And then let's make sure we correct this formula. Always remember to calculate your monthly repayments based on the monthly rate and not the annual rate. Now, the advantage of using Excel with the formulas, you can realize that instead of recreating everything from scratch, you simply go and just change the cell and the formula still holds. This helps you save a lot of time and also gives you consistency in terms of your results. Now, with that being done, these are your new monthly payments, and the loan balance at the end of the 5th year is 58,806.74. So another important thing to note, unlike capping the monthly payment amount, when the interest rate is capped, the amortization cannot be negative, unlike for the other case where once you cap the amount and the interest exceeds the monthly repayment, you end up with a negative amortization. So in this case, when the interest rate is capped, the loan will continue deducting without the negative amortization. You can also calculate the internal rate of return of the adjustable rate mortgage payments. So for this, when you need to do this in Excel, you need to capture all the cash flows. So you start with a positive amount being the loan, and each month's payment has to be listed. Therefore, you list it up to the end of the loan and simply use the IRR formula by highlighting all those amounts and guessing the expected rate. So with that, you'll be able to calculate the internal rate of return, which is also the yield of the adjustable rate mortgage. So this will capture the effective rate which has been in place, since the rate has been varying throughout the loan term. Now another thing which we can check is the additional concepts, analysis, and applications. So here we have comparison of two loans with different terms. So first, the incremental borrowing cost. Assume a borrower is purchasing a property for $1,000 and faces two possible loan alternatives. A lender is willing to make an 80% first mortgage loan of $80,000 for 25 years at 12% interest. The same lender is willing to lend 90% or $90,000 for 25 years at 13%. Both loans will have a fixed interest rates and a CPM and CPM. How should the borrower compare these two alternatives? So the CPM here stands for constant payment mortgage. So with this, let's jump into Excel and do it practically. So first of all, we need to capture the basic information. So here we'll have our options. So there's the first option and the second option. So for the first option, the loan amount is 80,000. The second option is 90,000. Now the annual rate for the first case was 12%. Or let's write it as 0.12. Then monthly rate will be equal to the annual rate divided by 12. And the loan term in years, it's 25 years. So loan term in months, you simply take the 25 and multiply it by 12. Now for the second option, which is 90,000, here the rate is 13%. For the monthly rate, we simply divide this by 12. The loan term still remains as 25. So the loan term in months is still 30. So first of all, let us calculate the monthly repayments. So we use the is equals to PMT. Let's add a negative there so that this answer becomes a positive number. So we take the rate, which is the monthly rate, comma, total number of periods, and the loan amount. Then close the brackets, press enter. So this amount, you can even leave it as a number format. So that's the monthly repayment, and this is the monthly repayment for the 90,000 loan. Now, if you're comparing these two loans, you get a difference between this loan amount and the earlier loan amount. So let's write a difference here. We less this from this. So that's an additional loan of 10,000. However, this additional loan leads also to an increment of monthly repayments by 172.47. So now you try and get the rate which is applicable for such a case where if you are taking a loan of 10,000, the monthly repayments are 172.47. And the loan term is 300,000. So what you're trying to figure out is the rate. So in this case, we'll use the formula is equals to rate into brackets, then take number of periods, the monthly repayments, and the loan amount. Then close the brackets. And then for this formula to work, you can see here, one of the amounts needs to be a negative for it to give us an accurate result. So in this case, let's take this as either one of these should be a negative. So instead of subtracting 824 from 1015, let's do the vice versa. So we take this less this, since it's in terms of cash flows. Now you'll find that this is the monthly rate. And then for us to get our annual rate, we'll simply multiply this by 12. Now this means that the annual rate of borrowing the additional 10,000 is 20%. And hereby, this 20.57% is greater than our loan rate amount of 13%. So it means that the additional amount being borrowed of 10,000 exceeds the interest that the borrower is willing to pay at 13%. So that's how you think about comparison of different loan amounts and different terms in relation to the interest amount within a loan. Now let's proceed and look at other different case scenarios. Now let's consider an early repayment. So assume early repayment at 5 years. So working again with the same problem, here we will try and figure out the loan balance after 5 years of each loan, then get the difference of that amount and still note the difference in the monthly repayments and try and calculate the interest rate applicable for the monthly repayments and the difference after 5 years. So to do this, let's proceed again to Excel and be able to calculate it. So for us to be able to figure out the loan balance at the end of the 5 years, we'll require an amortization table. So to do that, let's just create one for each loan. So here we'll note the month, then the payment, then the interest, the principal, and the balance. So for the first case, first option of the loan is 80,000. To begin with. And since we are working or looking at the balances at the end of 5 years, that means that's 60 months. So we simply drag it down up to 60. And then the payment amount is 842. So let's just lock that in. For the interest, we take the monthly rate multiplied by the previous balance. So we lock in the interest rate so that we can easily drag this down and have the population of the other payments for the other months. And for the balance, we simply take the balance less the principal. So this is the loan balance at the end of this particular period in time. Now again, let us proceed and get for option Now for the second option, we're working with 90,000. That's the loan amount. Then we drag this again all the way to 60 for it to be 5 years. So repayments are 1,015. For the interest rate, 0.0108 multiplied by the balance. With that, now we have the loan balance at the end of each period. So what we need then to note is the differences. So first, we look at the difference in the monthly repayments. So in our case, there's a difference. We take the 842.58 less the 1015.05. Well, that's the difference in the payments. And then you also look at the difference in the balances. So at the end of 5 years, the difference in the balances is, take this amount, less this. You can see it's 10,117.3. So now, what's the rate that will apply, assuming this payment to achieve this amount? So it's simply getting the discounting rate which will have been applied, assuming a monthly rate of this and a loan amount of this over the 5 years. So for that, you get by taking the is equals to rate, number of periods. So in this case, number of periods is 60. Then the monthly payments and the balance. And what we also need to note is the difference in the present value, or rather the initial loan amount. These future balances we can refer to them as our future value. And you can recall this difference was already calculated up here. It was 10,000 at the beginning. So we're trying to get what rate would apply if we had a present value of 10,000, monthly repayments of 172.47, which would lead us to have in the future 10,117.32. Now to get that, you can calculate the monthly rate using this formula. Is equals to rate. So we need to take the number of periods. So since it's over 5 years, that's 60 months. Then our payments, that amount there, 172.47. Our present value is 10,000, and the future value, since we can't put it as a positive, we'll add a negative and that amount. And with that, we close the brackets, press enter. But what we need is the annual rate, which we get by multiplying this by 12, which you can see now is 20.83%. Now, once we have this interest, we can simply compare it with the earlier interest which we had computed for the whole loan repayment. So you realize that in the event that there's an earlier repayment, the cost of this loan, or rather the rate, is higher than the rate which would have been if we had just let the loan run up to maturity. So with that, the way we explain it is the incremental cost of borrowing 10,000 is 20.83, which is greater than 20.57 incremental borrowing cost. The incremental borrowing cost increases with early repayments. Now let's do a comparison of two loans with different terms in relation to origination fees. So for the first option, the loan charges are 3%, and the second alternative 2%. So let's go back to Excel and be able to demonstrate this. So first, I'll simply copy this to help us save on time and clearly illustrate this. So now we have the loan amount, and we also have the loan charges. Or rather the loan fees. So for the first option, it's the loan fee is a 3%, which is actually 3% is for the loan which was 90,000, and 2% is for the one which was 80,000. And 3% for the 90. So that's the relevant loan fees. Now we need also to get the amount disbursed. This is the actual amount which the person receives after applying for this loan. Okay. Now, what we also have here, the annual rate and the loan term will still hold. This information will be the same. So let's just put it back here. So in this case, the actual amount which is disbursed has a difference over, let's take this amount and less this. Actually 8,900 and not the 10,000, because this is the actual amount which is received. And then the loan term still holds and the monthly repayments. So now what we're trying to establish is the effective rate. So the effective monthly rate that will give us a present value of 8,900, noting the monthly repayment being 300 and the loan amount being 172.47, this being the difference. So to do that, we simply take the formula is equals to rate, number of periods, then the payments, then the present value. And then we also need to multiply this by 12 to get the annual rate. So we can see from this that the annual rate is 23.18. This amount is also higher than the 20.57. So this means that the incremental cost of borrowing 10,000 is 23.18%, which is greater than 20.57% in the event that previously there were no generation fees. So the incremental borrowing costs increases with additional origination fees. Now let's look at another example. So in this example, we have a difference in maturities. So let's assume the 98,000 loan has 30 years maturity. So let's jump into Excel and do this practically. So let's just copy this. So for this case, the 90,000 loan has a loan maturity of 30 and not 25. So that's 360 months, unlike the 300 months. So since the loan term here is different, we can't simply calculate the difference as we had done earlier, since this difference will be from 1. So we have a difference of the differences here. So of course the difference in the loan amount still holds as 10,000. Now the difference on the loan repayments, this is where we'll get a difference, since we'll get a difference from the first year to 25th year. For this period in time, this is when all loans, or rather all loans, have an equal payment term. So that's when you can take this less that in terms of the cash flow. However, from year 25 to 30, the loan is only applicable for the 90,000. So we take that amount. So if you're to get to calculate the rate which will apply, if you have a present value of 10,000 and monthly repayments of 153,000 for 25 years, and later on after that, for the next 5 years, you're paying 995.58. So the way to easily do this is to create now the cash flow table for us to easily understand this. So here we'll have months and amount. So in month 0, we have 10,000. However, from month 1 all the way to 25 years, which is 300, the cash flow will be negative 153. So we can simply drag this down to 300. So the cash flows in this case will be equal to this. So let's just lock it. And drag it down up to 300. Okay, then from 301 all the way to 360, we have the other cash flow, which is let's first click on the first cell and then we go up and select the difference which we had earlier calculated. Which is this amount, 995.58. Now we can drag it down. Now for us to get the rate, monthly rate, we simply use the IRR formula. So we need to highlight all these 360 amounts and give a guess, and we'll be able to get our monthly rate. So we'll simply highlight that all the way up to 360. Then give it a guess, let's say 0.01. And then we also need to do this, get the annual. So you simply take this amount and multiply by 12. So now you can see the rate is 18.86. Now, what does this mean? This means the incremental cost of borrowing 10,000 with an extended maturity is 18.86%, which is less than 20.57, which we had earlier been able to get in the case where the loan terms were equal. From the previous example, we can be able to note that incremental borrowing costs reduce with the extension of the maturity period. This is because of the benefit of longer amortization period. So now let's look at comparison of two loans with different terms. So for loan refinancing, here we have an example. Assume a borrower made a mortgage loan of 5 years ago for 80,000 at 15% interest for 30 years. After 5 years, interest fall of 14% for 25 years. The loan balance on the existing loan is 78,976.5. Suppose the prepayment penalty of 2% must be paid on existing loan, and the new lender requires an origination fee of 2,500 plus 25 incidental closing cost. If the new loan is made, should the borrower refinance? So let's do this comparison through Excel. So let's calculate this through Excel. Now the loan amount is 80,000. The original loan term was 30 years. Now this in months, we'll simply multiply it by 12. Now the interest rate is 15%, is 0.15. Let's get the monthly rate, which is equals to the annual rate divided by 12. So with this information, we can calculate the monthly repayments. So formula is take is equals to PMT, then the rate, number of periods, and the loan amount. With that, we close the brackets, press enter. So we can see the monthly repayment is 1,011. Now let's also calculate the loan repayment, or rather the refinancing cost. So first of all, suppose the prepayment penalty of 2% must be paid on the existing loan. So with that, let's note the existing loan, which is 78,976.5. So we have a cost here of 2%. So prepayment penalty equal to this times 0.02. And then we also have an origination fee of 2,500. And finally, the incidental closing cost of 25. Now we get a total cost by adding all of this, is equals to sum brackets and add that. So we find our total cost is 4,104.5. Now, since this is a new loan, we'll have to calculate the new monthly repayments. So for the new loan, the loan amount will be equal to the loan balance. And the interest rate in this case is 14%. So it's 0.14. So the monthly rate will be equal to 0.14 divided by 12. Now, with this information, and also we need the loan term. Since we have already covered 5 years of the loan, and the loan was 30 years, now the remaining period is 25 years. The months, we simply multiply that by 12. So with this, we can calculate the monthly repayment, which will be equal to PMT brackets, get the monthly rate, the number of periods, which are 30, and the loan amount. So now, in this case, our monthly payments will be 950.96. So what's the saving? Loan saving. So for our case, the earlier monthly repayments were 1011 and now you're paying 950, so you have a saving. So we get this, take that less that, so your monthly payments have reduced by 60.87. However, for you to get this reduction in saving, the present value or the cost in this case will be equal to what you incur in terms of the charges of refinancing. So it will be equal to that amount. And of course, now the loan term is now 25 years, which is 300. So we're trying to get the yield by calculating for the rate which will apply. Assuming you want to know the rate applied for you to get this monthly saving of 60.87 when the present value is 4104.53. So with that, we use the formula is equals to rate to brackets, take the number of periods, take the payment and the loan amount. And then we also need to multiply it by 12 for us to get the yield. So this means that with the yield, the current yield on this saving is 17.568. So this means that for the person to refinance or for the refinancing to be viable, the borrower should lack an investment where they can put this 4,104 and earn an interest of less than 17.568%. So in the event that you can't find a valuable investment which can earn you a higher interest than 17.568%, you're better off refinancing this loan. We have now come to the end of the chapter on adjustable and floating rate mortgage loans. Attempt the quiz here below to further enhance your skills and your knowledge in relation to this particular topic and the lessons which have been learned. Now we'll proceed to the next chapter, which entails an introduction to income producing properties.